Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, November 19th, 2020. It's a pre-market right now with about half hour before the opening bell, but what I want to do in this video is something a little bit different. Typically, I'm focusing on trading opportunity, whether it's a sector, individual stocks, something else, commodities, or I'm doing a video on the broad markets covering that. We're going to hit on a little of everything, but and the video won't be real long. I want to just talk about really expand on some comments I made on the homepage this morning. It's something I've talked about, but I want to condense it together, and that is trading opportunities right now or lately, or lack thereof, more importantly. Now, what I mean by that is, I've always said, the stock market is not an ATM in which you can continually extract money from on a steady basis. You can't just go in every day, take money from the market. You have to, wait. I like to use the analogy. I love nature. I love watching those shows, Animal Planet. It's like a predator. You watch a cheetah. It doesn't sit there and run after every gazelle that walks by. It sits, waits patiently, waits for the right gazelle, whether it's sick, injured, small, to come close enough, and then it charges. If it went after everything it saw, it would quickly run out of energy and die. And the stock market's the same way. You have to wait patiently, wait for your setups. They might not be mine. I have my own trading style, my own charting style that I use, and I share what I see, and if it works for you, great, and if it doesn't, you need to wait for your own type of setups, and that may include stocks. I covered some penny stocks yesterday. I said they're very high risk, and if it's not your cup of tea, stay far away from those. And if you're okay with that, and you can make 100% in a few weeks, or you could lose 30, 40, go for it. All right, so what I'm going to cover today is simply the big picture on the various asset classes. I'm going to start out here only because we're here and it's pre-market. Just here's QQQ. There's that 15-minute wedge. Remember, I'm really you can tell lately I'm walking down my time frames. I'm more focused on this 15-minute chart than I have been on the usual 60-minute charts lately, and that's it's short-term stuff. Why is that? Well, here's what I'm going to talk about. The market has been stuck in a sideways trading range. I'm zooming out to a daily chart here for what I'm doing is if I grab where we closed yesterday and I move over to today, you can see on the pop-up box down at the bottom, that's 2.8 months, almost 3 months where we've gone absolutely nowhere. We're at the same level. Not to say we haven't gone anywhere. We've gone sideways, and within there have been trends to trade, and these have been identified with divergences, trend line breaks, things like that. So it's not to say that you couldn't actively swing trade or even get in tight. You won't see it here on the daily chart, but I've showed 15-minute charts, 60-minute charts where you can get these little quick 2, 3%, 4% hit and run trades. But the bigger picture is this. Make no mistake about it. It's a sideways trend. So I'm going to go over not just the market, but all asset classes. We're going to talk on that real quickly. Again, it won't be a very long video, but the final takeaway is I have a lot of sayings I've made up over the years and with trading, and one of those is, if patience is a virtue in life, you've heard that expression, to me it's an absolute necessity in trading. You can't squeeze water from a rock or blood from a stone. And again, if you're a trend trader, good luck trend trading this market, because again, if you went in long or short back here, you're back where you started almost 3 months later. So that is the reality. This is also a function of why you're not seeing a lot of official trade ideas. I don't have the confidence, long or short right now, to establish, long-term swing trades or trend trades. I'm giving you ideas every day if I see opportunities, but that's it for the market. Okay, that's QQQ. You might say, well, Randy, the QQQ is not the market. It's an important index. The S&P 500 is more of the stock market. Okay, let's do that. Here's where we are right now, and there's where we were almost 3 months ago, 2.6 months, right where we started. So you might say, well, the S&P just broke out to new highs, but it's also failed. It's back down below that high. And again, we're not all far off the highs, but this is, make no mistake about it, a multi-month sideways trading range where the stock market has gone nowhere. Okay, so that's it. These are equities. This is a trending market. 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 This is a sideways market right here. Sideways trends do not last forever, and typically the longer they last, the more energy. It's like a coil spring building up energy, and typically, not always, but the more powerful the ensuing trend once it emerges. Once you break out from that range. Okay, so that's it. What we're gonna do is show you real quick, quick crash course on investing 101. Okay, there are stocks are considered an asset class. You probably heard that term. If you didn't, we'll talk about that real quick. So we'll use Investopedia. They come up first. What are asset classes? I'm gonna, knock their definition. I don't agree with. If you read right here, they say, let's see. Okay, key takeaways. Let's just go down here. All right, an asset class is a grouping of investments that exhibit similar characteristics and are subject to the same laws and regulations. Okay, and so they say here, asset classes are equities, stocks, and bonds. The old asset class models you guys may be familiar with are, the percent of stocks or percent of your assets you should have in stocks and bonds. And the old rule is, again, when I entered the business as a stockbroker back in the 90s, financial advisor, the old rule was take the number 100, subtract your age, and that's how much you should have in equity. So if you're 20 years old, you should have 80% in equities because you're young, you have a lot of time, you can ride out market cycles, and the older you get, you pare that back and you put more into bonds. So the old rule was stocks and bonds. That was the simple rule. Again, it's a little more complex than that, but stocks and bonds. So these are your main asset classes. Equity, stock, which is ownership in a company. Bonds, which are actually debt. It's the opposite. It's an IOU. If you buy a bond from Apple, you buy Apple stock, you own a piece of the company. You're actually a part owner of Apple, one share of stock. You buy a bond, Apple owes you. It's an IOU. They've written that they promise to pay you a certain rate of interest, and when the bond comes due, pay your principal back. And then cash equivalents. Okay, as active traders, we'll just leave that out for now. It is certainly part of, a trader's portfolio, dry powder, et cetera, et cetera. Okay, so we have stocks, bonds, real estate, and then this is where I take, I differ. They're trying to treat these as separate asset classes, commodities and futures. I'm sorry, commodities is an asset class. I did a whole video on that yesterday. That is a separate. Commodities have typically nothing to do with the stock market or bonds or anything else or real estate. And then the rest I don't agree with. Futures, I trade futures all the time. A future is basically a contract that is tied to either stocks, bonds. You can trade futures on the 30-year Treasury bond, the 10-year Treasury. You can trade futures on the stock market. I post that every day in QES, or futures on commodities. So that's ridiculous. You can, whatever they want to call it, an asset class, but again, it tracks one or any of these and nothing else. I don't know of a future other than maybe on Bitcoin, and that maybe put it in its own asset class. Let's not get too complicated. I'm just talking the simple stuff here. And then other financial derivatives. What's a derivative? A derivative is really a future. It's something that it's tied to another asset. For example, options are derivatives. It's a put is a bet that a stock is going to drop, and a call is a bet a stock is going to go up. And so, but again, they're putting it in a different class. But if you buy calls on Apple, you're bullish on Apple, and if Apple goes up or the stock goes up, you profit. So, all right, I didn't want to. I'm sorry if that was a little long-winded here, but let's just keep it simple again, because those are really all tied into the other ones. There's your asset classes: stocks, bonds, real estate, and commodities. That's it. A pretty simple view. And now we're going to move on. We're going to look at each of those, and then I'll wrap the video up. Okay, so I already covered stocks. That's it. There it is. There's our multi-month sideways trading range. Say what you want about which way you think it's going to break. Who knows? Maybe get a whipsaw one way and then the other. But that's it. You can say what you want, but it's dead money. You've gone nowhere now for nearly or the stock market's gone nowhere lower now for nearly 3 months. And again, active swing traders can make money. Day traders or very active short-term traders can make money, but a trend trader is spinning his or her wheels in the stock market, and therefore most sectors also are moving sideways as well. Now, the video I did yesterday with trade ideas, if you'll notice, a lot of those are very niche sectors, and that's I'll continue to turn more focus to looking for those trading ops. There's always money to be made somewhere, but right now it's not, and it hasn't been in equities. So we're just going to say unless this trading range resolves and we find the next trend, not a lot of opportunities there. Okay, so now let's move on to the next one. The big one is bonds. We'll start with government bonds, TLT, corporate bonds. I'm sorry, TLT, government bonds, and it's been a sideways to down market. I've been adamant since back here, adamant that this is the only point in history where the outlook for bonds is virtually abysmal. There's no reason for a long-term investor. That old asset allocation model, it's busted now. There have always been times, and the reason it's busted, the Fed has taken rates, the central banks have taken rates to zero, which have taken bond rates. Yeah, we're not at zero on a 30-year Treasury bond, but we're below 1%. Therefore, what makes bonds go up and down in price are interest rates. They have an inverse correlation. You have virtually no more downside in rates. We hit a absolute panic thing there in the COVID lows, but that's really the floor on treasuries. So when I say there's virtually no more upside, there's a little bit of upside. Here it is in percentage terms. You have about maybe if all of a sudden there was a panic sell-off and a big rush into treasuries, you might have about 8% upside in treasury bonds, but your downside is unlimited. What I mean by that, you put money into TLT, you're collecting a fraction of a percent in interest, so you're getting paid almost nothing, and your downside is unlimited. What I mean by that, well, TYX is a long-term 30-year treasury bond, and interest rates have been in a secular bear market for decades now. This is the early 80s. This is Reagan coming into office and inheriting super high inflation, high interest rates, and we've been in a steady downtrend in long term. Again, these are 30-year Treasury bond rates. It was in a price channel, and what happened is we had some quirky, unnatural forces, a la the Fed, starting back in 2008. These are your quantitative easing programs, money printing, the heaviest hand manipulation that they could, coming in, stepping in to try to manipulate the financial markets as a whole with quantitative easing, bond buying programs, and they've caused this artificial extreme. And again, so there's the floor, and remember, there's from here. I see one of two things happening. We stay at ultra low, zero rates for years, and we don't get inflation. Because remember, the Fed does not control. They can certainly try to manipulate, but they don't outright control the long end of the yield curve. That means 30-year bond rates. They can exert forces on it. But if things beyond their control get away, namely inflation, or all of a sudden, for whatever reason, China, Russia, all these big countries decide they don't want to, Japan, they don't want to hold U.S. bonds. We're being reckless with our spending. We're entering a recession, and we keep spending. We're not going to be able to pay those bonds off other than a strategic default, which means that's where government just, they don't have the money to pay off the bonds, so they just print more bonds and to pay off the old bonds with, and that just devalues everything. So those are potentials that can happen. Either inflation that starts to run away, and then the Fed cannot maintain that zero interest rate in policy. They have to start bringing rates up to curtail inflation, like the assets, the commodities I just talked about the other day, housing prices, asset prices, And again, so I see at best, you go into a bond fund for the next, let's say you're a long-term investor, 5 years, you're earning nothing. You're not going to make anything on your principal, very little, if anything. You're going to collect paltry interest, next to nothing. However, if any of those risks happen and all of a sudden because nobody can argue that we have hit a floor, and again in rates. So this has been a cyclical bear market, but it's not going to continue. To go down there means you're going into negative rates, and people aren't going to put their money in a bond that's paying negative 2%, taking money from you. So there's a floor there. It's not an exact hard floor, but it's certainly pushing on like a mattress or whatever right there. So that's it. So I view, in the longer term view, rates from here, they can go sideways for a long time and stay on the floor, but pretty much they can only go up. And so that's not a good thing. And then at some point, we'll probably enter a cyclical bull market in interest rates. This bond only goes back here to the mid 70s or so. Okay, and then you have your corporate bonds as well. This is LQD. They were pretty much at a floor since the Great Depression. We had, the government came in, brought in. We've been in a low rate era now for over a decade. We were close to the floor, and then we hit the floor here. So you had this little pop up. But again, there is a ceiling there. It's not a super hard ceiling, but it's a soft ceiling, and we're at it. And so the same thing with corporate bonds. And this is actually where the government stepped in. The Fed did invoked emergency charters to allow them to come in and directly manipulate and buy bonds to shore this up. Otherwise, corporates would have been way down. And so again, I just wanted to go over the asset classes. And this is a weekly chart. We're showing a long-term chart. When we look at a daily chart, same thing I was just talking about in the stock market. Here's where we're at today in LQD. Here's where we were. If I just drag that line straight over, we're trading where we were 4.2 months ago. So just like the stock market, there has not been any opportunities. An investor has made absolutely nothing now for over 4 months in LQD other than the very paltry interest. And you might say, okay, well, I'm getting interest. But guess what? Your upside, as I just said, is extremely limited and in capital appreciation for those bonds. So you're collecting, 1% or maybe just north of that in LQD. I don't know, whatever it is, 2%, probably not much more than 3. But your downside risk, here's where LQD was before. And this may not happen overnight with the Fed in the market. Who knows? Anything's possible. But the drop, if you drop down to where you were in March, there's 23% downside there. And again, when you go back to a long-term chart, let's say we finally get that runaway inflation and the Fed can no longer maintain a zero interest rate in policy, or they lose control of the long end of the curve, then you're back to 2008. There's 45% downside if LQD trades there. So again, risk reward. I view every trade and every long-term investment from a risk reward perspective. You don't want to risk $1 to make $1. You want to risk $1, meaning that's how much you might lose on the trade, to make $3 or $4. And this is the most abysmal risk reward ratio on bonds, corporate, junk bonds, government bonds that we've ever had, again, in the history of the world, because we've never been down here at zero rate policy here in the US. So that's it. So I've covered now stocks, bonds. Stocks will trend. There will be an opportunity, long or short, in stocks, and the next opportunity is going to be a short on bonds. Once once we finally get that, we start seeing long-term rates trending up. As of now, I just stay away from it. So that's it. 2 asset classes that have been dead money lately, and again, that's reflective. No trade ideas there. Then you have real estate. The easiest way to look at it, IYR has been around forever. It was the first to market, I believe, REIT ETF. So if you want to get a kind of a quick gauge on the real estate market, and this isn't holding individual family houses. That you can look at Zillow Trends, read what's going on there. These are the various REITs, real estate investment trust. And there's all different types. You have Simon Property Group, the largest mall operator. A lot of shopping malls where you're at will have Simon and things like that. And again, all we're looking at here is a absolute go nowhere sideways trading range now for looking at where we're at. Go back here and 5.6 months. And really the beginning of the range starts about 6 months. So there it is. Those are your asset classes: stocks, bonds, and real estate. each and every one of them going nowhere. So while the media may cheer the all-time highs in the S&P 500 that we recently made, we're still in those trading ranges. And again, until and unless we start getting a trending market, this has been a zombie market for a while. There really aren't many opportunities. Now, the final one that I didn't cover yet, but I did a whole video on yesterday, were commodities. And I focus on agricultural commodities for a particular reason. So let's look at that. Let's look at DBA, which is, as I said, the most comprehensive, or one of the most comprehensive, the one I focus on. ETFs for agricultural commodities. That means you're excluding industrial metals, precious metals, oil, natural gas, just things that grow, things that come out of the ground here. And that's DBA. So we did have, for a while, there was a sideways trading range, but now this one broke out, and there's a great example of what I was telling you with the stock market. You get these ranges, they work like a coiled spring building energy, and then finally this one picked that leg up. That trend just over the last 3 months has been pretty nice, not huge. Again, this is DBA, it's diluted. I went through the individual commodities, and I've been very clear for many months now to show you which ones I like, and I've told you my preference is to get into the most bullish ones, avoid the most bearish, or those that are, maybe have had a big run but they're at resistance. You don't want to add, wait for a pullback or a breakout. And so most of the commodities that I've focused on have had runs of 20-30% or more. Again, this is going to be diluted to an extent because you have the best looking commodities and not. But either way you slice or dice it, it is a clear breakout again above that recent trading range. So here's the fourth asset class. Again, stocks, bonds, REITs, and commodities. Those were the four that we covered in the beginning of the video, and here's one that is clearly broken out and is clearly trending, and because of that, this should be the direction of the next major trend. All the indicators, or at least this PPO trend indicator down here, you use that zero line. PPO is above and has been above the zero line since this point. That's keeping that trend indicator bullish. Okay, and why have I not been as bullish on broad-based commodity funds? Here's one, for example, GCC. That's the Wisdom Tree Continuous Commodity Index Fund. I've got a couple others in here. GSG right there, because these contain crude oil, natural gas, and metals. They're broad-based commodity index funds. So you have your ag commodities, but you have the metals. The big one is crude. Crude is our big one, and crude has been, you talk about a go nowhere sideways range. This is a daily chart here. This is USO, the most popular, most liquid crude tracking ETN. And you can see just nothing but a tight sideways range. Oil plunged into the COVID lows, rightfully so. Planes stopped flying, cruise ships stopped sailing, et cetera. Then you had a little reinflation trade. But then you've been locked in a sideways market, and crude oil is trading today where it was 6 months ago. That's exactly on that pop-up box 6 months ago. And so therefore, and the outlook is, to me, I can't make heads or tails of this chart. I can just tell you it doesn't, it's not clearly bullish or bearish. Very little clues as to where oil goes. And again, those funds like GCC, for example, I believe I have the weightings. They're pretty heavy into crude oil. There, here you go. This is an older update, but it had back then 15% energy stocks, or energy, not including natural gas, and so again, that's where I'm leaning towards the ag commodity. Okay, now you can treat gold if you want, I think, as a separate asset class. Technically it'll fall under the commodities, but of course people use it also as a flight to safety instrument, somewhere they put money, or an inflation hedge. And gold, I've been very clear on. We've been very bullish on gold for a long time, but back here stated that I personally closing out all my long-term trend positions on the miners and the metals. Even put on a couple shorts expecting a pullback because we hit major resistance on both gold as well as the euro, and support on the US dollar, and it's been a multi-month grind. So sometimes I haven't put a lot of official short trade ideas. But sometimes it's not so much as the trade ideas that I share that make money, but it's the ones, hey, get out. We're probably looking at a decent correction, and that could either be a consolidation or a correction in price or time. It's been a little of both, and so if nothing else, it may have saved those from buying gold here, buying gold stocks. Now we're at my all along my initial and minimum pullback target was this 173.87. We hit it quickly right after the top. We've been bouncing on it. We have a potential trend line here. I'm not crazy about it because you had one breach, but it's still a decent trend line. And I said if that goes, look, we could come down to here. Either way, I've been very clear. Near-term direction is a little bit obscure to me, but long-term, I'm waiting for gold to break out from those all-time highs, and I'm waiting for the euro-US dollar pair to take out this major downtrend line, the blue downtrend line. That with gold hitting the long-term resistance and silver also hitting resistance, and the euro-US dollar pair hitting here. That's when, like I said, I closed them out and expected a correction in gold, and we've had that. And again, this will be, I believe, this plus gold taking out the highs will be the next long-term buy signal. I'm still longer-term bullish, but it's been months now, again, where there's been no money to be made in gold. In fact, it's gone down a little. So I just wanted to say that's been a dead money trade too. Won't be forever. Like I said, nothing goes in a sideways range forever. Here's what gold looks like. We dropped 10, 11%, and we're flirting right here. There's a 173.78. That's support. So you could buy gold here, and I'll tell you this: if gold drops at all, even if it just holds up here, I'm going to put a line tool. Give me 1 second. Color this up. Change the color. Here we go. We're at support, and we have positive divergence right here. You can have the indicators are making higher highs so far. They're still pointed lower, so it's what I call unconfirmed divergence, not confirmed. We need to turn the indicators back up. But prices can either be making equal or lower lows to give you a positive divergence. So technically we have positive divergence. Again, it's unconfirmed. Should gold pop below there, really wouldn't surprise me. When you've been tapping on a level when you're bearish trend, a lot of times the powers that be, the market makers, algos, will take it down, and what that does is run the stops. You get a lot of people a little short gold, longs will throw in the towel because their stops are set right below that very, very well watched support level. So I would almost lean towards that. It doesn't mean it has to happen, but that's what I'd lean towards. And then a pop and a reversal and come in and take out. So this right now, if I had to take a bet, my best guess would be the most likely snare for gold. If it wants to run all the way down to the next support, that's going to come in at 168.70, excuse me, and hopefully that keeps those divergences intact. So there's gold. The near-term outlook. GDX, I've always said this. You really don't have to. You should watch the chart, but GDX is just going to follow gold. I mean, this is no surprise. This is. They topped around the same time. You had an uptrend line here. You had a bearish rising wedge. I could see no better reason to get out of your miners because gold hit long-term resistance. Silver, the US dollar, the euro, they were all at support or resistance. GDX broke from the bearish rising wedge. If you missed the breakdown, you had a chance to get out of your miners on the back test or short, and it's been a downtrend. We're coming up on support now. If that support goes, this is an even better support. I'll tell you, I would love to see GDX get down here to 31.33 because that is a very good support level. And if the charts of gold, silver, and the US dollar, and of course GDX confirm, that's where I will be interested in re-entering long-term trades back into the metals and miners here. Okay, I'm going to wrap it up. Told you it wouldn't go super long, but in summary, I've covered every single asset class, and the only one that has broken out of a multi-month trading range recently have been those ag commodities. Everything else is locked in either a sideways range, or in the case of gold, it's actually a downtrend, really. Again, bigger picture, when I go to that weekly chart, I view this as just, kind of a correction. It's a little bit in time and mostly, or a little bit in price, mostly in time. I mean, gold's not down huge off the highs, 23%. Sorry, this is GDX. GDX is going to move a lot more than gold. I already covered gold. But let's wrap it up here, guys. Let me get this out to you. And the takeaway from this, patience. Patience, patience, patience. Don't try to force trades. Don't become frustrated. Don't think just because, I'm not posting a lot of trade ideas that there, isn't going to be an opportunity where all of a sudden, when it rains, it pours. You guys know how it works. And when the markets break out, or a certain sector, or the precious metals, it's like popcorn. Price alerts start going off, breakouts happen, and from those periods of consolidations and corrections, usually come a powerful trend after that. So I'm going to wrap it up here, get it out to you guys, and I'll follow up with anything else that stands out today. This has been Randy Finney with Right Side of the Chart. Have a great day.